Picture this. It's a Tuesday afternoon. You're sitting at your kitchen table. Nothing special going on. And you get a notification on your phone. It's from your bank, but it's not your bank exactly. It's a letter, a formal letter. And at the top of that letter, in plain black ink, are 3 letters that make most Americans feel a specific kind of dread. IRS. And the funny thing is, you didn't think you did anything wrong. You were just sending money to your roommate for rent. You sold a few things on Facebook Marketplace. Maybe you did a little freelance work on the side, and somebody paid you through Venmo because it was easier. Normal stuff. Everyday stuff. The kind of stuff millions of Americans do every single week without giving it a second thought. But here's what nobody told you. And I mean nobody. Not your bank, not the app, not the little terms and conditions you clicked through when you signed up. Nobody sat you down and said, every dollar that flows through these apps is now being watched, tracked, reported, sent directly to a government agency with the legal authority to audit you, fine you, and in extreme cases, prosecute you. This is not a scare tactic. This is not a conspiracy theory. This is federal law. And it changed, quietly, without much fanfare. And most Americans have absolutely no idea it happened. By the time this video is over, you will understand exactly what changed, exactly how the IRS is using it, exactly what dollar amounts put you on their radar, and exactly how to structure your payments going forward so that you're not handing the government a reason to come knocking on your door. Stay with me, because this is one of those things where the more you know, the more you realize you needed to know it yesterday. Chapter 1, the rule that changed everything and how quietly it happened. Let's go back to 2021, the American Rescue Plan Act. You probably remember it as the COVID relief bill, the one that sent out stimulus checks, extended unemployment benefits, tried to help people survive what was happening to the economy. It passed in March of 2021, and most of the coverage focused on those direct payments. But buried inside that bill, on page after page of dense legislative language that almost nobody actually reads, was a provision that had nothing to do with relief. It had everything to do with surveillance. Specifically, it changed a rule called the 1099-K reporting threshold. Now, before your eyes glaze over, let me tell you why that matters in plain English. A 1099-K is a tax form. It's the form that payment platforms, Venmo, Cash App, PayPal, Zelle in some cases, Stripe, Square, all of them, are required to send to the IRS when someone receives money through their platform above a certain amount. It's essentially a report card. It says, hey IRS, this person received this much money through our system this year. You should probably know about that. Before 2021, the threshold for triggering that form was $20,000 in payments and more than 200 separate transactions. Both conditions had to be met. So unless you are running a pretty serious business through Venmo, you are essentially invisible to this system. The average person sending and receiving a few $100s here and there, the IRS wasn't getting a report about you. You were under the radar. Then the American Rescue Plan changed the threshold to $600. $600 total for the year in payments received. That's it. That's the new line. One transaction over $600, or several smaller ones that add up to $600 over the course of a year, and these platforms are now legally required to generate a 1099-K form with your information on it and file it with the IRS. Now the implementation has been delayed and adjusted. The IRS has been rolling this out in phases because the backlash was significant, and their own systems weren't ready for the flood of new forms. For the 2024 tax year, the threshold was set at $5,000 as a transitional measure. For 2025 and beyond, the plan is to bring it down to $600. The direction of travel is clear. The destination is $600. And even at $5,000, we are talking about a level of financial surveillance that simply did not exist for ordinary Americans just a few years ago. Think about what $600 means in real life. That's splitting rent with a roommate for 1 month. That's selling your old laptop. That's getting paid for 2 or 3 small freelance jobs. That's your friend paying you back for concert tickets. That's babysitting money. That's tutoring. That's the money your mom sent you when your car broke down. The IRS now wants to know about all of it. Chapter 2: What they're actually looking for and how audits get triggered. Here's where I want you to pay close attention, because this is the part that most of the panicked social media posts get wrong, and getting it wrong can actually make your situation worse. Receiving a 1099-K does not automatically mean you owe taxes. Let me say that again because it's important. The form itself is not a tax bill. It's a report. It tells the IRS that money flowed to you. It does not tell them whether that money was income, a reimbursement, a gift, a loan repayment, or something you're legally allowed to exclude. But, and this is a significant but, if you receive that form and you don't report it correctly on your tax return, that is where your problems begin. The IRS matches forms. They have automated systems that cross-reference the 1099-K filed by Venmo or Cash App with what you put on your return. If those numbers don't line up, a flag gets raised. That flag can lead to a letter asking for clarification. That letter can lead to an audit, and an audit opens up your entire financial life for examination. What actually triggers escalation is a pattern of discrepancy. The IRS isn't manually reviewing every $600 transaction. They don't have the staff for that, and frankly, neither does their budget. What they're looking for, through automated systems, is mismatches. Money reported on a 1099-K that doesn't show up anywhere on your return. Business income that appears to be flowing through personal accounts. Payments that look like they have a commercial nature, meaning you're selling goods or services that are being treated as personal. This is where the gig economy gets complicated. If you drive for Uber or Lyft, those companies already report your income. But if you're doing informal work, mowing lawns, designing logos for people, selling handmade goods, doing alterations, tutoring kids in your neighborhood, and people are paying you through Venmo, the IRS is now getting a report about that money, whether you've been treating it as income or not. The question they're asking is, did you report this? And if not, why not? There's also something called the business account distinction, and this matters enormously. Venmo and Cash App both offer personal accounts and business accounts. If you're using a personal account, but consistently receiving money in a way that looks commercial, lots of small payments, notes that say things like logo design or cleaning service or lesson payment, the platform may reclassify your account or flag the activity. Some platforms have already started doing this automatically based on transaction patterns. The bottom line on audit triggers is this: it's not about the amount so much as it's about consistency and explanation. A $4,000 payment from your friend paying you back for a shared vacation they charged to your card? Probably fine if documented. 400 payments of $10 each with notes suggesting you're running a service business? That's a different conversation. Chapter 3: The apps themselves. Who's reporting what and where the gaps are. Let's talk about the specific platforms because they are not all the same, and understanding the differences might matter for how you manage your financial life going forward. Venmo, which is owned by PayPal, began implementing the new reporting rules aggressively. They started requiring users to confirm their tax identification information, meaning your social security number or employer identification number, before they would allow you to continue receiving payments above threshold amounts. If you've used Venmo in the last couple of years, you may have seen those prompts. That was them building the infrastructure to comply with 1099-K reporting requirements. Cash App similarly started collecting tax information and began issuing 1099-K forms to users who hit the applicable thresholds. Square, which operates under the same parent company as Cash App, has been doing this for business accounts for years and extended it more broadly. PayPal has been the most vocal about the $600 rule, actually sending communications to users warning them about the change. They have well-established reporting infrastructure because they've been doing this at the $20,000 threshold for over a decade. Now here's something interesting about Zelle. Zelle operates differently from the others because it is bank-to-bank transfer infrastructure. It's owned by a consortium of major banks, including Bank of America, Chase, and Wells Fargo. Because Zelle moves money directly between bank accounts rather than holding it in a digital wallet, it has historically been considered outside the scope of 1099-K reporting requirements. As of the most recent IRS guidance, bank-to-bank transfers through Zelle are not subject to the same 1099-K reporting rules that apply to third-party payment networks. That distinction is real, and it matters. But before you decide Zelle is your magic loophole, understand this. Your bank reports to the IRS in other ways. The interest in your accounts is reported. Large deposits get flagged under Bank Secrecy Act requirements, and the IRS can issue a summons to your bank directly if they're already investigating you for something else. Zelle isn't invisible. It's just currently in a different reporting category. Cryptocurrency payment apps add another layer entirely. If you're receiving payments in Bitcoin or any other cryptocurrency through apps like Coinbase or Crypto.com, those transactions have their own reporting requirements under different rules, and the IRS has been expanding crypto reporting obligations dramatically. That's a whole separate video, but the short version is, don't assume crypto payments are outside the IRS's view, because they are very much not. Apple Pay and Google Pay in peer-to-peer mode largely operate through bank accounts and don't generate 1099-K forms the same way standalone payment apps do. But again, this is a regulatory area that continues to evolve, and what's true today may not be true in 18 months. The landscape is shifting faster than most people realize, and the agencies are playing catch-up. But they are playing catch-up. They are not standing still. Chapter 4. The moment you realize this is about you. I want to stop for a second and be direct with you. If you're watching this and you're thinking, this doesn't really apply to me. I'm not a business owner. I'm just a regular person. I need you to think about something. Did you sell anything this year? Clothes on Poshmark, electronics on eBay, furniture on Facebook Marketplace, anything. Did you do any work for anyone outside of a traditional W-2 job? Helped a neighbor with their computer? Watched someone's dog while they were on vacation? Drove someone to the airport? Designed something for a friend's small business? Anything. Did you participate in a group expense that got paid and then reimbursed through Venmo? A group trip? A shared gift? A dinner where one person paid and everyone else sent their share? If you answered yes to any of those, and statistically, most Americans watching this have, then the rules we're talking about could touch your life. They may already be touching your life, and you don't know it yet. Here's the personal implication that I want you to sit with. If you received more than $5,000 in payments through these platforms in 2024, a 1099-K was or will be generated with your Social Security number on it and filed with the IRS. That form exists whether you know about it or not, whether you asked for it or not, whether you expected it or not. And when you file your taxes, the IRS will be looking to see if what's on that form matches what you reported. If there's a mismatch, you'll hear from them. If you got that form in the mail and threw it away thinking it was junk mail, and some people do, that doesn't make the IRS's copy disappear. If you did work on the side and got paid through these apps, and you've been thinking of it as extra cash and not income, the law has always considered it income. What's changed is that now there's a paper trail confirming it exists. This is a situation where a rule changed. Millions of people don't know about it, and the consequences of not knowing can range from an uncomfortable letter to a real financial penalty to, in cases of repeated willful non-reporting, something far more serious. I'm not saying this to scare you. I'm saying it because knowing it gives you the ability to do something about it. Chapter 5. The legal facts they don't want to explain in the app's terms of service. Let me give you the specific legal framework so you understand what you're actually dealing with. The legal basis for all of this is Section 9774 of the American Rescue Plan Act of 2021, which amended Section 6050W of the Internal Revenue Code. That section governs information reporting by payment settlement entities, meaning companies that process payments. The amendment dropped the reporting threshold from $20,000 and 200 transactions to $600 with no transaction minimum. Under this law, payment platforms are not just permitted to report your transactions to the IRS, they are legally required to. Failure to do so exposes them to penalties. So this isn't a case where an app is choosing to cooperate with the government. They have no choice. The report is automatic and mandatory. Here's the little-known legal fact I want you to hold on to. The IRS can assess what's called a substitute for return. This means that if you receive a 1099-K and fail to file a tax return or file one that doesn't address the income on that form, the IRS has the legal authority to file a tax return on your behalf, using the most unfavorable assumptions possible. They will assume the highest possible tax rate, they will give you no deductions, and they will send you a bill for what they calculate you owe, plus penalties and interest. You then have to prove them wrong, which means the burden of proof flits to you. Instead of the IRS proving you owe money, you have to prove you don't. That is a profoundly uncomfortable position to be in, especially if you haven't been keeping records. There's also the matter of the accuracy-related penalty under Section 6662 of the Internal Revenue Code. If the IRS determines that you substantially understated your income, meaning the amount you underreported is more than 10% of the correct tax, or more than $5,000, whichever is greater, they can add a penalty of 20% on top of whatever tax they determine you owe. That's 20% on top of the tax, on top of the interest that's been accumulating since the original due date. And in cases where the IRS decides the underreporting was fraudulent, meaning they believe you knew about the income and intentionally hid it, that penalty jumps to 75%. These are the numbers that matter, not just the $600 threshold, the downstream consequences of ignoring that threshold. One more thing worth knowing. The IRS has a whistleblower program that pays informants between 15% and 30% of collected proceeds when they report tax evasion of $2 million or more. That program exists and people use it. If you're operating an informal business, doing substantial volume, the person who might report you isn't just an algorithm. It could be a disgruntled contractor, a former business partner, or a competitor who's angry you're not playing by the same rules they are. Chapter 6. The Safe Payment Structure. How to move money without painting a target on yourself. All right, you sat with the uncomfortable truth. Now let's talk about what you actually do. First, and I cannot stress this enough, the goal here is not to hide income. Hiding income is a crime. The goal is to understand the rules clearly enough that you're not accidentally creating the appearance of a problem when no problem actually exists. There is a profound difference between tax evasion, which is illegal, and tax avoidance, which is completely legal, and what every competent financial advisor in America will tell you to do. So here is the framework for structuring your payments intelligently. The first thing you need to do is separate your personal payments from anything that looks commercial. If you are doing any kind of work for money, any kind, even informally, do not run it through the same Venmo account you use to split bills with your friends. Open a separate account. Better yet, if you are consistently earning money from a service or product, formalize it. Get an LLC. Get an EIN. That's an employer identification number, which is free to obtain from the IRS directly at irs.gov. Having an EIN means your business activity is reported under that number, not your Social Security number, and you are filing business taxes that account for your income and your legitimate business expenses, which reduce what you owe. Second, document everything, every reimbursement, every loan repayment, every shared expense. The IRS can ask you to explain any payment. If your roommate sent you $800 for their share of rent and utilities, that should be documented somewhere. A simple text message, an email, a note in a shared document, something that establishes what the payment was for. Reimbursements are not income. Loan repayments are not income. Gifts under $18,000 are generally not taxable to the recipient. But you need to be able to demonstrate what category a payment falls into if you're ever asked. Third, understand the $600 threshold in context of your total annual receipts. If you know you're going to receive more than $600 through these platforms in a year, which for most active users is merely certain, then start keeping track. Don't wait until January when the forms arrive. Keep a simple spreadsheet or even a note on your phone. What came in, what it was for, whether it was income or reimbursement. This takes 10 minutes a month, and it is the difference between being prepared and being caught flat-footed. Fourth, for purely personal payments, splitting dinner, paying back a friend, family transfers, use platforms and methods that carry less reporting complexity. Bank-to-bank transfers, Zelle, writing an actual check, using cash for small personal transactions. None of these are foolproof under all circumstances, but for genuinely personal transactions between people with no commercial nature, they create less administrative noise. Fifth, if you are a seller, if you sell things on eBay, Etsy, Poshmark, Depop, Facebook Marketplace, any of these platforms, understand that selling personal items at a loss is generally not a taxable event. If you bought a couch for $800 2 years ago and sold it for $200, you have a loss on a personal item, not income. You are not required to pay tax on that. But you may still receive a 1099-K if you cross the threshold in total transactions. And you need to know how to report that on your return correctly so that the IRS doesn't assume all of it is profit. The way to do this is to report the gross amount shown on the 1099-K, and then document and deduct your cost basis, meaning what you originally paid for the items. Your tax preparer can walk you through this. The key is not ignoring the form. Sixth, if you are self-employed in any capacity and you're receiving payments through these apps, start making estimated quarterly tax payments. The IRS expects self-employed people to pay taxes throughout the year, not just in April. If you've been letting it pile up and paying at filing time, you may already be accruing an underpayment penalty. The quarterly deadlines are typically April 15th, June 15th, September 15th, and January 15th. Missing those dates costs you money even if you're square on the total amount owed. And seventh, get a tax professional. I know that sounds like something everyone says, but I mean it specifically in the context of this new reporting environment. The rules around gig income, informal work, digital payments, and 1099-K reporting are genuinely complex, and they're changing. A CPA or an enrolled agent who specializes in self-employment income will very likely save you more money than they cost you, and they become your first line of defense if the IRS ever does come calling. Chapter 7. What's coming next? The direction this is all heading. I want to leave you with a clear-eyed view of where this is going, because the $600 rule is not the end of the story. It's the beginning. The IRS received an $80 billion budget increase through the Inflation Reduction Act of 2022. A significant portion of that funding was earmarked for technology modernization and increased enforcement. The agency has explicitly stated that it is focused on closing what it calls the tax gap, the difference between what Americans owe in taxes and what they actually pay, which the IRS estimates at over $600 billion per year. The digital payment reporting rules are one piece of that enforcement expansion, but the infrastructure being built goes well beyond Venmo and Cash App. The IRS is investing in data analytics capabilities that can cross-reference information from multiple sources simultaneously. Your payment apps, your bank accounts, your social media presence, your business listings, your real estate records, and more. The goal is to build a complete financial picture of individual taxpayers without having to manually audit each one. What this means practically is that the era of the cash economy, the era where informal work and off-the-books income existed in a regulatory gray zone, is ending. Not overnight, not all at once, but directionally, unambiguously, the government is building the tools to see more, report more, and collect more. This isn't necessarily evil. There are legitimate arguments that the tax gap disproportionately benefits wealthy people who can afford sophisticated tax avoidance structures, and that closing it funds public services that people depend on. You can believe that, and still believe that individual taxpayers deserve to understand exactly what rules they're operating under, which is the entire point of this video. You now know what the rule is, you know why it changed, you know what the specific thresholds are and how they'll evolve. You know what actually triggers an audit and what the penalties look like. You know which platforms report and how. You know what a substitute for return is and why you never want to receive one. And you have a 7-part framework for structuring your finances so that you're not creating confusion or exposure where none needs to exist. The IRS isn't always the villain in this story. Sometimes it's just a system that changed, information that didn't reach you, and a set of rules you're now equipped to follow. You know now, and knowing is the only protection that actually works. If this video helped you understand something you didn't fully understand before, share it with someone who needs to hear it. Not because I'm asking you to grow this channel, but because there are people in your life who are walking around right now completely unaware that a form with their Social Security number on it is being filed with the federal government based on their Venmo activity. They deserve to know. If you want to go deeper on any specific piece of this, the 1099-K form itself, how to handle it on your return, how to set up an LLC correctly, how quarterly estimated taxes work, those are all separate videos, and I'll link them. Every piece of this connects to the next. One last thing. The government is building better tools to find money they think you owe. The only rational response is to build a better understanding of the rules they're using to look for it. That's what this channel exists to do. Stay informed, stay compliant, and stay ahead.